Hey everybody, my big head is there blocking out blocking out the sorry about that. Blocking out the market move, which it's slid a little bit lower here over the last I don't know, about 30 minutes. It's kind of an interesting market here, really. Thank you guys all for joining us here. I know it's a little bit later in the afternoon. We did this kind of short notice. The note was a little bit late today, and we apologize for that. So that's why we wanted to squeeze in this live session to just give a quick update of what's going on. We also posted out that I guess it wasn't that long, but that article this morning that talked about the implied volatility market and the dynamic that we're currently seeing. I am assuming all you guys can hear me, so it says that you're experiencing buffering, so let me make some adjustments here, see what I could do to improve that. There we go, hopefully that'll help a little bit. Perfect. Okay, good. Everyone can hear me. That's what I was worried about. So, so we want to talk about two things here. I'll move over a little bit more so you can see that market movement again. And really what the big thing is, as we all know, is there's this upcoming expiration next week. And historically, that has led to volatility in the markets. And that article really lays it out. If you go to our website and you click on the blog, you can read this. Subscribers, I think you guys have already seen this. But basically, what we talk about is the fact that generally what happens is we get volatility in the market, and then short term, that's guys trading this, the weekly options or whatever it may be, they'll come in and start selling those, right? The same day volume in options is humongous for the spiders and the SPX in particular. And so what will happen is, generally, we get a little bit of volatility. The short-term, shorter duration vol traders come in and they start selling that stuff as soon as they can, as fast as they can. And typically that's enough to reward, typically they get rewarded there, right? The market will bounce. That dynamic will drive the market back up. Vol collapses, and that turns out to be a decent short-term trade. But the dynamic here is really a few things. One, the value you get from selling the very short duration options is much lower now. And when we talk about value, we're talking about the implied volatility. So we put this chart together here, and we'll slide this over. We talked about this chart here in the, this is posted in the article so you can get a kind of a bigger view of that. But what we're really talking about is if you look at the purple area here. So if we bring up this little fancy pen tool here, I think I can actually draw on this chart. You can see right here is what I'm talking about, right? These purple options are the very short term, that's like 0 days to expiration, right? 2 days to expiration. Oops, sorry about that. And so the issue is when you're selling these very short term options is that you're betting on volatility inevitably collapsing, right? So in other words, typically, when you're selling a 1 day expiration option, if you're selling the option that exists out in here, right, you're betting that the market's not going to move, let's say 1.5%, right? But now, when you're selling the very short-term duration option, you're only betting that the market's going to move maybe 50 basis points at most, right? And the average return in the S&P, even for a decent day, is going to be obviously much higher than that 50 basis points. So it's very easy to get blown out of that position. And then the other issue is, as we note in this article, is that because the Fed is coming up on the 22nd, the bigger vol sellers are probably not as likely to step up, right, because of that event. So we could have OPEX trigger some volatility, and then you could have like maybe retail sellers come in, or very shorter term options traders come in, but the bigger guys don't want to sell that vol, right, because of the FOMC. And that could simply smash, right, or run over those short duration or smaller vol traders, right? And so what we look at is we say, okay, well, if the shorter term option sellers get run over, what really could happen? So we talk about Contango versus backwardation in the options market. This is Contango, and it's pretty steep Contango, which is a good headwind for equities. Longer dated vol is bid, which means that there are hedges in place, right? But the shorter dated vol is getting sold at, and SPX is trading at a vol that's much lower than the VIX implies. or that you see kind of relative to the VIX. And so what will happen is those very short-term option sellers will get run over in the fact that in this term structure here will shift to backwardation. And that should happen, we think, very quickly, even if there's just a little bit of volatility. So when we call for market drawdown, I have no idea what the Fed is going to do. The Fed may be very accommodative, in which case there's a lot of vol that could come off, and that could actually send the market up quite high. But the issue is that when you're trying to sell these short-term options, this could be that reflexive feedback mechanism could break, right, and work against people really quite rapidly. So if you remember, we talked about in September there was this issue, because if you zoom back and we look at September of last year, it was, there was this unbelievable ramp in the market, right, in the month of August, and then the unwind happened so fast, right? We lost 10% in the matter of just a couple of weeks, and obviously we bounced there and recovered pretty quickly. And we think that's what would happen if we did get a sell-off, right? But this reflexive vol positioning, this short-term, short vol in the short term could get run over, and that would be a positioning, really like mismatch, right? And that is what we think would be the catalyst for really kind of a large drawdown. And the reason that we bring up the 4,000 level is, we talked about this before, there's a huge option position at 4,000, and it's just that big fat round number which people really like. And so we think that the combination of those two would put 40 the 4,000 area as kind of a support. Now that's a pretty big drawdown, don't get me wrong, 10%. But honestly, if you were to pull down 10% in the context of this market, that's really just kind of a blip, and we think it would recover pretty quickly again, because that longer dated vol is pretty elevated. So that could provide some hedging as those long vol traders, the guys that have the longer dated volatilities, they close their positions out. That could help to kind of buoy the market if there is a longer term drawdown. So if we just sort of zoom back in today, I think there is this general feeling of weakening. I mean, you could see that, we noted this morning 44.25 was our high in the daily note, and the market did break a little bit over that to 44.30, but really this 44.25 line was the high of the day. And there's a lot of options positioned at this level at 44.25, and then obviously the next big level is 44.50, and we have the gamma flip line at 44.95. So, this pullback, this mean reversion in between these big levels is not really surprising to us. It will catch us a little off guard here if this does not hold, this 44.95 area doesn't hold into the close, particularly because there's an expiration tomorrow. We think that should support the market a little bit, because there still are some pretty big positions in this 45 area, 4,500, 450 spider area. So as those roll off, it's about 10% of SPX expires tomorrow. 20% of spiders expires tomorrow, which is typical. That will loosen this up a little bit, right? And the more we pull away from this 450 area, the lower gamma kind of gets, right? It starts to get slippery under this line. And so, this is setting up to get weak before expiration. And there's been a lot of conversation as of late about how volatility and gamma is the gamma volatility dynamic, which used to hold very tightly into expiration, is changing. And I'll be honest, I didn't really feel into that dynamic. I think that there are some positioning things, particularly spiders is now a much larger part of the market, the gamma market in the S&P 500 than the SPX, and so I think that has changed who the players are. I think there's more retail in spiders. They're more active. They're a bigger part of the market, and that has changed this gamma dynamic, the gamma vol dynamic a little bit. But I did put this chart together for everybody for this presentation, or for this talk today. This is the vol chart that we noted before, but I've shown this to our subscribers before, and I want to focus specifically on this middle chart. So the top chart is the S&P 500. The bottom chart is realized volatility. So realized volatility, as we noted in that article, the Reflexive Weatherman article, realized volatility is pretty much near a lower bound, right? At least for 2021. But what I really want to talk about is this center chart. So this center chart is what we call compression. Now, all that means is that we look at the high and the low of trading for every single day. So if you believe in the gamma dynamic, that means that regardless kind of what the high and the lows of the market, that means that we should have a tighter trading range, right? Because if gamma is higher, then that means that dealers should suppress, tongue twister, volatility, intraday volatility, right? So we should, in theory, have tighter trading ranges. That means a lower or tighter high-low on the day. So If this figure here is above this green line, that's indicating there's a big swing in the day, or at least a very large directional move. In other words, the high and the low was really quite wide. And if the figure is below this red line, that indicates it was a very tight trading range. So what would you expect to see? Well, in OPEX days, we would expect to see tight trading ranges, right? We would expect the market to find these big gamma areas, like 450 or 4,500 in today's market, and we expect a pin, right? And the market not to move off of that. And that's what you see. So what I've circled here are all of the monthly options expiration dates over 2021. So you can see here's January OPEX, February, March, April, etc. And you notice that as we get into those expirations, the trading range, the high-low of the day, compresses on that day. And then when we get to at the end of the month, kind of mid-cycle, the high-low expands, the trading range expands. And that's exactly what we would think we would see based on this gamma dynamic. And then what's kind of interesting is look at the May, June, July OPEXs. Those didn't really adhere. They did in the fact that mid-month was the lowest or tightest trading range, and then end of month was kind of looser, right? It had a wider trading range. But the real sort of intraday range didn't really adhere as much over the last, call it 4 months, well, really 3 months here. August seemed to respect that just slightly. So the dynamic has shifted a little bit. The GEX Gamma Vol, Friday expiration dynamic has shifted a little bit. And so I bring that up because as we sort of watch the market here, we're still not in a humongous trading range, right? This is still only a 50 basis point trading range. This is Bookmap with our hero indicator. It's not a huge trade. 50 pips is not really that big of a deal. We would expect a bounce, right? If the gamma dynamic is in place, we'd expect a bounce here in the market to kind of feed back up into this, 45-20 fair value area. So we haven't really broken the GEX rule, right? The pin into OPEX. But the dynamic does seem to be wearing away. And I think a lot of people are nervous about sort of Monday, Tuesday, Wednesday. And it is clear that regardless of whether or not people are front running or adjusting this, the third Friday of every month, it is clear that everyone is aware of this phenomenon at this point, right? That there's no secret there. So do you really do you adjust how you trade because of that, particularly in light of this volatility dynamic we've been talking? The other thing I want to note about this is something to think about. We have the quarterly expirations as well, and I have not had time to really dig into these statistics. But if you think about this, we have a large monthly expiration, so it's very large for single stock equities as well as SPX and SPY. That takes place on next Friday, which is the 17th. But then we have this quarterly expiration, and those of you who track this stuff often will know that there's a lot of big institutions that will trade the quarterly expirations. Those expire on the 30th of each month. So there are some very serious positions at the 30th of each month. There's that big JP Morgan collar trade, for instance, and I think there's that infamous gamma hammer, they call it, I believe, which is the fund starts with a P, Paranomic. Sorry, drawing a blank on the name. But there's the gamma hammer. If you look that up, fund, I believe they trade in the quarterly options expirations as well. So I think what can happen there is you have market makers and dealers that may balance their books between that mid-month expiration and the quarter-end expiration, and you can arguably see some of that in this high-low data, right? Because if you note here, there was very tight compression on the end of the half year, so the June 30th quarterly expiration, we saw this compression dynamic on that day. We didn't see something like that in February, really, so that didn't really come in we didn't see that in the quarter end March dynamic. There was a stranger dynamic in June, which I would sort of use as an explanation for the compression on January 1st, on July 1st. And so I'm not sure what we're going to see here, but I just want everyone to sort of take note of that, right? There's that little extra, I don't know. And if the Fed upsets people or really kind of gets gamma moving, right, or creates some volatility, good or bad, that could become quite an interesting thing to note from kind of the September 22nd to September 30th expiration in that sort of time frame or that window. So with that, I'm going to lean over here and see if I can check out some of your questions. I hope that helped explain. Again, we have that article. You can always post comments in this in the question below, but I'll take some of the questions here. I got to lean over for that. my face video with buffers. I think that's probably a good thing. I'm going to say. I'm going to guess there, Eugene. So I apologize for that, guys. So Paul, I think you're saying doesn't the vol show up after OPEX? And first I want to tell you, we've done a lot of feedback on these videos. I typically don't like to show up on the screen. But people seem to like that. They feel like I'm a little more attentive, or they know who they're talking to. So my big head is going to get in the way. I'll make some adjustments going forward on that. So I'm sorry, Paul. But yeah, so this is the question, Paul, and I think I addressed it. Hopefully I didn't. If I didn't, but the question is, the whole market typically knows, okay, vol is going to collapse on the OPEX third Friday of every month, and then it's going to release the next month, right? And are people front running that dynamic, right? Are they starting to say, okay, the relative low was still here over, May and June. It did seem to change a little bit in July and come back in August. So, the jury's still out. What is clear is everybody knows that there's this volatility dynamic, right, or lack of vol as we approach OPEX, and then vol expands the following week. Now, the other thing I would note about this is that this has been an incredible bull market, right? Every little dip gets sold. And I know from some of my personal models that when we do have a quote-unquote sell signal or a long volatility signal, vol does express, right? But it's just a low amount compared to the last few years. It's a high level of volatility versus sort of just this last, 2021. But every little dip, every little micro dip gets bought. And so that is not lost on us when we talk about this dynamic. That's part of the reason that we called the article The Weatherman, right? Because we had an issue here in the Northeast where Hurricane Henry was supposed to come and do a lot of damage, and nothing happened, right? I mean, literally nothing happened. I waited in line like half an hour to get gas, right? All that sort of stuff, and there was no storm. And then the next week was the Hurricane Ida, and that messed stuff up pretty good, but nobody paid any attention to it because it said, Henry, forget it. So that was kind of the background or thought process for the name of the weatherman, because a lot of times the weatherman is wrong, but you still need to know if he says a hurricane is coming, you still got to be ready, right? And that's kind of what we're trying to portray here, right? The dynamic is strange. OPEX, FOMC, vol selling is compressed things. All those little key components are in line, and you need to sort of respect that. So maybe you want to buy some hedges and say, look, I know I'm going to lose some money here hedging if I'm wrong, but it's a good time to have some of that protection in place. We also, as a side note, I'll be putting out an article this weekend which talks about what the performance is of going to cash when the market hits our vol trigger, or aka gamma flip line. It's quite interesting, the results of that study. It doesn't perform as well as the S&P, but obviously the volatility, so that would probably produce a better Sharpe ratio, which is really what its intention is. So let's see some of the other questions here. Parametric fund. Thank you, SpotGamma support. I believe that's Julia. Hi, Julia. Yeah, so Jay, you're asking a question about AMC. AMC is quite interesting, and it always is interesting to me because the traders in AMC are kind of funny, and the stock, these stocks with AMC and GameStop, obviously, they've settled into this big area. And I think the whole reason they've settled in is because there's this massive options complex. There's like 3 million contracts outstanding in AMC, and that just kind of buoys the stock. It just sort of holds it in. Now, most of that position expires in January, so that's going to be hey, Brent, you are right, if the stock really untethers from that level. And what's so fascinating, and I try to talk to the apes about this, and I don't get much feedback on it. But even if you're holding long, we talked about this, and we put out a bunch of data on this. But you could sell so the stock was at 44. You could sell the at the money or the 45 strike iron fly. So $5 wide, 45 strike fly for $3. So even if you're holding 100 shares, you could sell the 45 strike iron fly, collect $3. That's almost 10%. And that 10% is betting that the stock is not going to move more than $3. So, right now is breaking that level, right? But as we move a little more towards OPEX and those calls decay, I have a lot of confidence that the stock would drift back to that 45 area, which is where a lot of big gamma is positioned. So even if you're a long holder, you could sell flies against that, and your risk is $2. So if there is that unbelievable infinity squeeze, well, you lost $2 out of the entire infinity however much that is, right? You lost $2. But if you're right 2 weeks in a row by selling that $3 iron fly, well, then you're up on doing that trade, right? So I guess it's called position management. So anyways, 45 is really the position where that strike that we're looking at. And if we pull this up in the equity hub, you can see that. I'll wait for this thing to load here 1 second. And the other thing that was interesting about GameStop is that they're talking about the volatility and the volume and who the players are, and the interest is really just faded. Which is it's kind of like this idea of they're AMC and GameStop. They're fighting Wall Street, and like they show up on the field ready for battle and they're fighting, but they're not fighting against anybody. It's like, it's like swinging your sword in the air and saying you're fighting. Like there's no one else there. Like nobody really cares. Doesn't mean the stock can't rip higher. Maybe that's arguably better if Wall Street's ignoring it, that the stock could really rip. But as you can see here, the most of the gamut at the moment is at 50. 40 is still the big strike, but these are a lot of calls. And so as these calls decay into tomorrow, that weighs on things a little bit. 45 still has a lot of position there. So, 50 would be the high tomorrow, but I would bet on this thing kind of mean reverting back inside today, just due to that charm dynamic of call options decaying and the position sort of weakening. I'm sorry, Mr. Samko, I'm going to mispronounce your name. So the issue with the September 17th and September 30 expiration, I can definitely help explain that. So the quarterly expirations are the big expirations for huge institutions. So if you look back, for instance, in the COVID crash in March, you can Google this. You can Google Bridgewater March put positions. They had on huge put positions they put on in November of 2019. And those put positions were quarterly expirations. And big institutions typically won't close those positions out, meaning they'll let them expire, right? They can put that trade on. They're going to hold them to expiration. If they're in the money, great. If they're out of the money, c'est la vie, right? So you can actually find that those positions, the low of the market, as many of you have heard me say this before, was on the third Friday of expiration in that month. Well, there's also a lot of volume that's tied to the quarterly expiration, which expires on the 30th. So if you are a dealer and you're hedging out your book, or you have big options positions on, and I think this can happen sometimes in the SPX and SPY on the same day, that if you're a dealer and you're hedging your position is probably fairly dynamic, right? Your book right now may have positions for the third Friday and the end of year, and those are hedged out, right? Or excuse me, the end of month, so the 17th and the 30th. Those positions are balanced against each other, right, in their book. And so as you kind of get to the 17th and those shorter, those become short duration options, much shorter than today, and you have to adjust your hedges and you have to move your book around and figure out what's in the money and what's not, I think that there can be some forces in there that can shove the market around a little bit, right? And particularly with the Fed kind of position in there, it's just an unknown, right? It's just a known that there are big positions on the 17th. There are big positions on the 30th. If you have a big S&P book, you're probably balanced between those two dates. But there's an additional dynamic that's at play there, right? And I think as we get a little bit closer, we'll be able to sort of assess what that dynamic is. But if you look at the S&P right now, for example, the bulk of Gamma and the bulk of Delta, both of those are tied to the September 17th expiration. So that's a very large expiration. I expect that the day after this expiration takes place, the largest Gamma position and largest Delta position will be in the 9/30 expiration. So that is sort of what the dynamic is. It is a little bit of a je ne sais quoi, right? I'm not sure exactly what will happen, but you want to note that there are these inflection points, that there are these dates that you kind of want to pay attention to, and the FOMC in between those could really shift how the market wants to react to those various levels. So you can see here again how well the 45-25 strike played into capping today's market. And again, the vol triggers right in this area, 44.95. So we'll see if this kind of lifts back up into the 44.10 line. Dennis, I've not seen people front running that JPM trade. that's just kind of a hedge. I think it's a big position. I think it figures into the gamma trade, particularly if we're at or around those strikes, which I think we may be kind of at or around those levels now. But while it is a big position, I don't think there's much to maybe front run. I think what you can do is when someone knows the trade's about to hit the tape, they can monkey with some other positions in futures. It's likely that whoever does that trade wants to lay it off against some other brokers, and so the word gets out about it. And I think kind of like on a very small or short-term basis, there can be some funky movements like intraday around when that trade goes up, but I don't think anybody can really position around it on a day-to-day basis, right? Yeah, so Ace Trader saying, so am I saying this not the best moment to sell options expiring on 9/17 to capitalize on a volatility collapse? That is basically what I'm saying. It's a succinct way of saying it. Normally we would say, okay, just on Monday, sell the 9/17 like at the money fly, right? And just wait for things to expire. And I think because we have VIX expiration on the 15th, that can loosen things up. People might be front running this 9/17 trade that I'm more hesitant to say that we're going to pin into expiration, right? It's not to say we can't. I'm just saying that the risk reward at this point is poor because you're selling. I mean, I was looking at yesterday, and I think I make note of it in this article that the options that expired in 3 days were only pricing in something like a 60 basis point move, very tight, right? So you're just not getting much reward for trying to sell S&P options that are even out 5 days in time, right? So it wouldn't take much of a move to sort of upset the apple cart, flip us into negative gamma, and boom, we're down, I think, at 44.50 very quickly into expiration. So, at 44.50, do you want to start selling some vol based on some of the dynamics that we see? I can maybe argue that, right? But the vol is going to be much higher. VIX will be higher. There'll be more meat on the bone, right? More juice to squeeze when you talk about trying to capture some volatility premium. So, the risk reward, I think, is just very much different. Paul's asking about Netflix. I haven't looked at Netflix in a while. If it's at 600, that's something else. Yeah, 600. Look at that. So 30% of the gamma expires there. I mean, you can see this thing comes down to 600, and that just looks like a very sticky level because so much is expiring as well. That seems like a pretty interesting trade. I don't know what like the at the money options are going for, but the 600 pin, I mean, that makes a lot of sense there. The Cameco CCJ gamma levels. I don't know much about that, Marco. I can't really comment much on that. I'm assuming that's this stock here. This position does not look all that big to me. So, it's also a very small amount of gamma that doesn't expire to 17. So I don't think options have a whole lot of a position in there. So Paul notes if you short the 4,200 SPX put spreads for September 17th, he did it a while ago. Seems like a nice trade. I don't think we hit 4,200 by next Friday. That would be really something else. Question about the gamma exposures. Are they calculated on open interest based on the assumptions that dealers are always short puts and long calls? For the S&P 500, that is correct. For individual single stocks, we just assume that dealers are short calls and puts. We're working on a lot of math and statistics around those position assumptions, and hopefully in the next month we'll have a revision to our models. But we think really what the key is just noting when there is a lot of change in gamma and when positions are moving around, and that it acts as the catalyst for a stock. mRNA. Kevin Q is complaining his questions keep getting ignored. I'm going to answer Kevin Q's questions next as soon as we look at mRNA. mRNA, we wrote an article about this couple weeks back, and I think we did a pretty good job of calling a big move lower and then also the bounce, right? 917 is when most of the game is there. It's not a lot of weekly expirations. 430 seems like the big level in this stock. So, I don't track this one too closely. I would look at where this position is on Monday. There's a lot of game expiring next Friday at 450. So this might be an interesting short. Might be an interesting way to play a pin here or fading kind of this ramp higher. Admittedly, I don't know what's going on. I hate oftentimes commenting on these biotech or medical stocks because this is a huge move higher obviously today. I have no idea why it's up this much. I'm just looking at the options position. So take all this with a grain of salt. But if this strike doesn't move higher on Monday. In other words, even though it has this big up day, but 450 is still the big strike and 430 is where most of the gamma is, then that would tell me that the options position didn't change higher. So that gives me a little more fuel, a little more interest in wanting to fade that move, right? Anytime the gamma levels shift up, then I say, okay, the options market has restruck this thing. So, then I want to actually kind of play long probably rather than trying to short that thing. Kevin Q, I'm going to look at his question here. He says, if there's not a lot of supply and institutional selling VIX calls before OPEX, wouldn't it make it more volatile since there's less supply? Making less liquidity on VIX makes it spike even more. Yes. So whether it's dealers selling or people selling VIX calls or selling S&P puts, the point is the same thing, right? Generally what happens is people come in and they slam vol, they sell vol. When you look at that volatility curve in VIX Central, you can see there's a huge amount of contango, right? And so that is the options catalyst because the front, that volatility, right? The VIX front month future is going to come down to spot VIX, which VIX has been holding higher, but there's a lot of collapse there, right? There's a lot of contango there. It's a very steep curve. So that is a fuel for markets, I believe. Now, the issue, as we said before, and kind of countless several times here, is that the juice in the SPX options. If you look at the SPX, you see VIX at 18, 19, right? You wouldn't think that the 2-3 day out S&P options are only trading at like a 10 or 11 implied vol. I mean, it's just very very tight. So you're not getting much for selling those options, and the normal supply should probably, we think, be affected by the fact that the FOMC is there. So there's less short vol supply. And you can make an argument that there's a bid or people want to buy volatility, right? And so that is what could run over that short supply pretty quickly for short covering and something else. And, there's one other thing I want to make a mention here. We start to talk about margin calls and how things unwind and all that. When you're long options, right, you're not going to get a margin call on long options. Assuming you've paid for the premium and you're not on a margin in some way. But when you're short options, you can get margin called pretty quickly, and that's what gives you the forced short covering, right? And a lot of people say, well, my margin is fine and all that sort of things. But when things get squirrely and markets really shift around, brokers can change their margin requirements, quite dynamically. So there's just a lot of risk in this short vol trade. Things that can happen and get unwound, right? And I'm not saying that we're going to have this massive 30% drawdown. I do think a Volmageddon type scenario is possible. I don't think a S&P drawdown is more than 10%. But if you think about Volmageddon and how high VIX went, the vol of vol in that case, I think we can get a lot of vol of vol this time and a pretty good drawdown. But I don't think it's going to be the same as like the same VIX movement as like a Volmageddon where people get blown out of the water and that VIX trade collapses. Because the longer dated vol is still bid a little bit, right? So that's why I'm calling for like a pretty nasty drop, but not like a cataclysmic type end of days scenario. Not that Volmageddon was, unless you were in those VIX ETPs, and then it wasn't end of day scenarios because they went to zero. So so hopefully that answers Kevin Q's question. I want to make sure he goes home happy today. Jayshwin, question about the sandbox filter. So we built the sandbox filter, which you can see here in the Equity Hub, because we wanted to just give everybody a quick idea of what names the options market had the highest amount of activity in, right? So we set up a bunch of custom sort of filters in here, and this just tells you, hey, what names is options positions large, right? Because if their options position is too small, the options market, we don't think can have an impact on the stock. So the sandbox says, here are all the names where options seem to matter. Now, obviously, some of these like VIX and VIX and TQQQ, the triple long ETF are somewhat obvious, but some of these are interesting, right? Ride is kind of interesting, Wish, some of these other ones that show up where I would start to look around at these names and say, okay, I know the options market's big in here, and that might give me a little more edge when I'm trying to set up my trades, right? Wish at 7, I don't know where the stock is trading, but Wish at 7, look at that, it's pinning that level, right? DraftKings, I think, is trading over this level, but this is interesting in tomorrow, 9-10, 37% of the gamma expires. There's a lot of positions at $60. Just quite a bit lower. So, I'm more interested in trading these names where there's significant options position. If there's no options trading, if there's no gamma, if there's no open interest, then my data has really no value for you, right? I can't really help you out there. But if I can identify which names have big options positions or rapidly changing options positions, then I think my data is helping you get a little bit of extra edge. So the sandbox is meant to filter out for those big positions. Now, that's different from the gamma squeeze. The gamma squeeze is a rough idea of how we can set up looking for the next gamma squeeze. So we want to see call positions changing, open interest moving up. There's a couple of different parameters in there, but you can see it's a pretty concise page here in terms of what we would look for in a gamma squeeze. Not every single one of these names is a great component, but if you find one good gamma squeeze out of these 20 names, that can make your year, right? If you find it right. So these are always being adjusted a little bit and played with. If you have any questions or comments on the names you're finding in here, let us know. All this stuff is dynamic, right? We want to keep updating it and make sure it's relevant. Clark asked about TLT options trading have an effect on the 30-year futures. I've heard people say that it does. I've never actually looked at that myself. I know that the bond traders they will trade this ETF. It is always a very large option position, and interesting things happen in it, right? I mean, I don't know. 150 is a big gamma strike. It sort of fades off that a little bit. To be honest with you, I've never thought about examining that. I know that there's a few other guys that run models on this stuff that seem to think that there's a link or a correlation here, but it's something that we for sure can investigate, and is an interesting idea. I'll make a note, Clark, to sort of look at that. Ryan Wong asked, the large gamma combo 1, 2, 3, 4 and the NDX Russells carry more weight. Yes. So anytime you're looking at our levels and you see L1, so if I flip the book map here, and we see what's going on in our friends with the ES, you see L1, L2. Level 1 is the most gamma. L2 is the second amount of gamma, right? So that's why we put that number in front of the position. Now, the one thing that this is not doing is weighting things. So is L1 bigger than L1 of 2 weeks ago? You're not going to get that from the label, right? You need more of our information to figure that out. But the weighting does sort of matter. So if you look quickly at this position, then right. You can just glean where the most of the gamma is, right? Because L1 is here, so that's a combination spider SPX. That's way up here. L2 is 45, 25. L3 is 45. Then gamma flips. So you can kind of see like, okay, well, look, there's a building gamma up here. This is why we think there's resistance. And that means that if we move lower, there's a little more room to sort of drop down kind of quickly, right? And then kind of arguably maybe grind back higher. So that is kind of that dynamic. My views on Amazon. Let's check that stock out. I thought I had Amazon up in the feed there. So Amazon, a lot of gamma expiring for tomorrow. 3,200 and 3,500. So this thing pinning 3,500 makes sense to me. I think you make a note of the selling puts for 10.15. Sean, I can't really comment on that. I just in general don't like. I like selling volatility or would look at selling puts when the stock is dropping. So this stock has had a pretty good run, right? And this is just again, I don't offer investment advice. I just offer you things to think about. But, I think about options like energy, right? And you want to buy and sell options based on that energy. So if we kind of just look at Amazon here, when is interesting to sell puts? Well, when puts have their most value. When do they have the most value? When the stock is dropping, right? Because those put values gain energy, they charge, and that's when you want to sell them, in my view, right? In this case, the stock has ripped, which probably means that put options have, lost a lot of their value. There could be a lot of volatility over the next 2 weeks, and so you're selling when vol is probably low. I haven't looked at vol on Amazon, but I'm guessing because of this move over the last several days that vol is low. And then the stock is kind of pinned at this gamma level. And so, I don't know. If you're making a fundamental call that you don't think the stock's going to go back down that low, more power to you. But I'm an opportunist, right? When I see that the market is moving down, that's when you want to sell. And the same thing goes, I think in here when you're looking at the S&P. When this option drops, right? If you're going to sell puts off of this drop, the put, whatever put you choose, like tomorrow's put, if you sell the at the money put, the minute that, let's say you timed this low perfectly, even though the stock stopped going lower here, right, you're going to make money on the fact that vol likely collapsed because the stock just traded sideways, right? The energy of this move charges those puts. You want to sell those short-term puts if you like to sell vol, obviously. If you were to sell vol, you want to sell on this kind of like ramp down, right? Because if you sell puts up here, right, the vol's low, there's not much energy, there's not much going on, it's going to drop. The same thing with selling calls or buying calls, right? You want to look at buying calls when there's not much movement and when the stock rips and you get, this energized move. I mean, watch vol move in calls in like AMC, right? And the call here, if you bought the call and the stock goes up, $2 and you don't sell it, right? The energy comes off, so your delta made you money, right? Because of the fact the stock went higher, but the vol comes down because the stock lost that energy, right? And it can happen on a very short-term basis. You just watch options trade, and you can see here like big hero move, and the stock just rips higher. Hero stops, the vol stops, the call buyers pause, stock pauses, vol comes down. Yeah, so let's talk about the gamma flip levels on spiders and SPX. So our gamma flip level in the S&P 500 is currently at 44.95. So the model I want to show here is the equity hub model. So 44.95 is where we see gamma flipping from positive to negative. Now what we have found that to be very useful when market is declining is the use of this equity hub chart. So what this equity hub chart is doing is this is plotting out the rate of change of gamma. So if you want to look up speed, that is the third derivative, or is that derivative gamma? So the third derivative delta. So in this case, you see 44.40 is this big level, and then 44.85, this level's moved down a little bit, is where the rate of change of gamma for S&P shifts, and that's because there's big gamma positions at 44.70 down to 44.45 and then 44.40. So what this is basically saying is that gamma changes very quickly here to 44.85 and then it sort of is sticky again to 44.30. And we think that has implications. When the gamma is changing, dealers are likely having to more quickly adjust their positions. And that's kind of what we're trying to zoom in or highlight to people here. So that's why we kind of are marking this 44.90 area as, okay, gamma is roughly flipping just above this level. There's this inflection point here. And so we think a break of that 44.90 area would very quickly kind of push us down into really just 44.65 or 44.70 at this point. A couple days ago, there wasn't this kind of bump at 44.70. And if we were sitting here, however, at 44.40, you would see there's a big change of gamma, right? Because put options are gaining in value. If we break 44.40, that means the rate of change of gamma is very high, and that doesn't really seem to change until, down around, you could argue like 4,300, right? So, and obviously this would be a rapidly changing dynamic. So that is sort of what's interesting also, and why we sort of pushed out these articles about the changing vol landscape now, because just as we were just talking about the energy of options and not wanting, like, you don't want to buy puts when the market is crashing, right? You kind of already likely missed the moves oftentimes, and you're quite possibly paying too much. So the relative, gains you would get from from buying puts or hedging now ahead of the possible change in dynamic is better, arguably, than you're going to get if the market starts to really crash or move down quickly after OPEX, right? In other words, you're paying a lower vol right now. You're paying cheap vol. And particularly if you buy options that take after the FOMC, you're kind of getting like a good, couple weeks to carry there, right? Because vol is not going to come down. Those options are going to hold their value a little bit better because of the FOMC. People are likely to hold hedges, long hedges, for after the FOMC. They do it every single quarterly FOMC visit. Talk. So in my view, you kind of have like a nice time to buy puts where the carry is arguably cheaper because of the FOMC. You have this catalyst pre-FOMC. So, obviously you can lose money buying puts on the decay and the theta. The market could rip. I could be completely wrong on everything. But I think when you're buying puts at, when the S&P at the money vol is like a 10 or 11, there's arguably a lot less to go than if you're buying puts, when the market was down 2% today. Did we have backwardation in vol at September 20? Yeah, you certainly did. So if you look at if we look at this chart, what I think is kind of interesting or neat about this chart here, and we put this in the article, is that the backwardation. So what we're looking at here, our purple dots are so these are all 25 delta options, right? And the reason we use 25 delta is so that we're comparing the equivalent options across time. So if we just looked at the strike, well, obviously the S&P changes value, but a 25 delta should always be equal. 25 delta in September of 2020 should be equal to a 25 delta option today, right? So it normalizes what we're looking at. And we have very short-term options here, right? 5 days to expiration is purple. And then we include every single 25 delta option our model can find all the way up to 30 days to expiration. Okay, so that's 1 month out. So we're always going to capture a monthly option and then a very short-term option. So the purple dots, generally, as you can see in normal periods, like here. So I think I can zoom in a little bit on this. So the purple options, try to get my fat head out of the way here. The purple options are the short-term options. So if we have Contango, that means that the purple options, the short-term, short duration options, should have a much lower vol than the 30-day options to expiration, right? So you can, if you plot those out, you would get a curve, right? You can see that there's purple, then light blue, which is roughly at 10 days to expiration, and then yellow, which is the 30. Now, when the market crashes, the demand for short-term options generally spikes. And the reason is because those will be cheaper on a premium basis to buy. People will rush in and there's more demand for those short-term options. So what happens is the relative vol of those, the energy of those options will get bid up relative to backdated options. So you can see that in 2018, this is a huge spike here, right? Where purple, the short-term options trade way over yellow, the longer day options. This is backwardation. So huge backwardation, right, in March of 2020. Huge backwardation in the September crash, which is here. And then obviously there were some other interesting points. This is the election where backwardation around the there was backwardation around the election, right? So this is what we're talking about now. So right now we have a big gap between these two, right? Not huge, but a big gap between the 30 to short-term expiration. So that could collapse pretty quickly. And we think that vol sellers will probably step in when that starts to happen. And then because the FOMC, if anything upsets that apple cart, then you go from this situation to where the purple options would trade at a premium to the longer dated options. So that would be, again, backwardation. What time of hedging will, so James, the theory is what time of hedging will market makers do if the spider continues to go lower and crash? The theory is that they would need to sell stock, right? If the market starts to decline and dealers are short put options, they need to sell futures and sell stock as the stock declines. Now, if demand for options increases, and you can generally gauge that by watching the VIX, if the VIX goes up, that is the easy way of saying, okay, people are buying puts. Right, VIX is a measure of S&P options. If the S&P options are getting more expensive, there's a demand for options, and if the market is crashing, that demand is likely for puts. So puts are getting more expensive. That's our dirty way of saying, okay, people are buying puts, dealers got a short stock. And Q is trading right at the vol trigger. So the Qs have been this really kind of interesting dynamic, right? Because they have traded at a kind of a negative gamma position for quite some time. So if we look at our Vanna model, you can really see that. And what the Vanna model is trying to portray is if implied vol changes, delta changes because of that. So we try to incorporate in our Vanna models, okay, the market is moving and vol is likely to shift in a likely way. Obviously, the market goes up, the VIX comes down, or vol comes down. And if the market drops, then volatility goes up. So that's what these models are trying to encompass or show you, right? So in the S&P, you can see we call this a neutral dynamic. And I think hopefully I can use this little fancy pen tool here to help show this. But, we call this the... So if we look up here, you can see, and what you can see is that the sorry, 1 second here, I'll get myself sorted. Okay, so you can see here that we call this a neutral dynamic in the SPX because the the skew is very flat. So this means that dealers have like a little bit to sell here, and if the market goes down, they have a little bit to sell, but it's a pretty neutral position, right? It's just there's not much of an edge, we think, to the support and resistance line. And if you think about where gamma is in general, we're at 4,500. We're just above zero gamma, right? So it makes sense that this area here is kind of a neutral position, right? So if we then flip to look at the Qs, you can see how this dynamic changes, and it's kind of interesting. So look at Qs. So you can see the skew of the model here, right? And it's shaped like this. This is telling us that there's a lot of negative gamma in Qs. And the reason I can tell that is because the skew shows us that if the market goes up, that the deltas decline. And that means that market makers likely have to. So when I talk about the deltas, that means the delta position for options decline. So if the options delta declines, then market makers who are short futures can start buying futures back, right? Because they don't need to. If they were hedging, if they had, if their long delta position was 100 here, right? That means they'd have to sell 100 worth of futures, right? And if then all of a sudden their delta position goes down to 97, that means that they can sell this many futures, right? That's kind of what the idea. Excuse me. They can buy back. Apologies. They can buy back this many futures. So as the market goes up, their options delta position goes down, which means they don't need to be short as much stock as before, and they can buy stock back. Okay, so hopefully I made that clear. Now, if the market crashes, you can see that the delta of their Q portfolio goes higher, right? If you're short puts and the market starts to decline on you, you're getting longer and longer the market as the market goes down. So you need to keep selling more and more futures as the market drops. And so this is a very volatile position because of that. If the skew was the other way, right? If the skew, and I think if I zoom back a little bit here, you can see that the skew is opposite in S&P a couple days ago. And this shows resistance. In other words, this is resistance because as you can see, the delta gets longer as the market went up into 45.70, right? The delta of the position gets longer. So market makers need to sell futures as the market goes up in this case, which should keep a cap on things. And that's the antithesis, or not the antithesis. This is what the vanna model is trying to portray. So you want to look at the skew of that model as an indication of how volatile or the volatility potential in those products. Monkey asked a question. There is no VIX index in the 86 crash. I believe you are correct there. Do I reckon that the 86 crash VIX reached 100 or higher? I think you're talking about the 87 crash there, Monkey. I'm not sure. I'm going to say that I don't think it would reach 100, and I'm going to base that on the fact that I don't think it reached 100. It didn't reach 100 in the COVID crash, and so I would think not. But that's just a total guess. Melissa Stone, Rouge, appreciate you do these. You're welcome, Melissa. Let's see if there's any more questions in here. If not, I know we're kind of getting to 3:30, the final hour here. One final note on the Q. So most of that Q position expires, I believe. So oftentimes I talk about when big puts or calls expire, that can be a change in dynamic for the stock. There's a really famous, I call it famous, but over the summer, I think it was like in April, there was huge Q put positions that expired, and the stock, as we got closer to expiration, as those puts decayed, Qs just went crazy. They ripped higher because those puts decayed and were rolling off. So, if you are looking for volatility, Qs is where you want to look in general. So you can see here we're pinning the 380 level where most of the calls are. We have this hedge wall, which is it's equivalent to the gamma flip line, right, in our core model, our main model. And you see that the gamma that's lining up, right, is 917. So if nothing happens in the market, we know that there's big put positions, right, in the market, and there's this weird skew. The put positions are going to start to decay a little bit, and that can kind of put a little floor into Qs. Now, on the same dynamic, this could be a very volatile position if we start to slide earlier because we have a lot of calls that decay, and the puts are going to gain in value if we push down towards 350. So it's an interesting shift, right? This is why there's more potential for volatility in our model showing for Qs than there are for for SPX, simply on the basis of where the call and puts are really positioned. And you can see the rate of change of gamma here, right, is much different. This is 382, and look how sharp, how much the rate of change of gamma right down to 372. I mean, you can see that all these put positions really would change the dealer hedging, or how they'll have to hedge, right? And because they're puts, this is why this is red in the model, right? This is telling put gamma is in control when you see red anytime we cross under 382. So these are bigger put positions relative to the call positions at 380. So that is why there's more potential volatility in the near term in Qs than in SPX. So hopefully that is kind of clear by looking at this model. I mean, if we flip over to spiders, you'll see a difference in that dynamic, right? Spiders has this hitch here that you can see at 449, 450. We kind of ping pong between these two levels, and then 20% of gamma expires in spiders on the next week's expiration. So tomorrow's expiration is pretty small. It shouldn't change this dynamic all that much. Spiders a little more similar to the Qs than than the SPX, but you always gotta look at SPX and SPY as one entity, right? You don't want to separate those out. Whereas I get this question a lot. I'm going to touch on this real quickly. The Nasdaq position is just very thin, and people are saying, "Oh, Nasdaq's over its call wall." You don't comment on that. It's so much different than Qs. What's going on? The open interest in the Nasdaq, and I don't think that's in the S&P model, so I apologize if I believe that is the case. Yeah. So the open interest in the Nasdaq is very small. It's jumpy. It's thin. It will have some concentrated positions, so that's why the combo strikes are useful. But it changes so much, and the dynamics completely different than the other models, right? The Q position is very consistent. Things roll, things change. There's open interest at all prices, right? Whereas Qs will have very chunky, sporadic positions in terms of its options positions, and so that's why we tend to ignore the NDX oftentimes. And as these models kind of load, I mean, you can see look how well formed, right, this Q expiration is. It looks like just like SPX, looks just like SPY. You know what is going on here. And then when you compare that to NDX, it's like, these positions are kind of all over. They also are a fraction of the size, right, if you look at the y-axis here of the Qs. And so, I think big institutions will sometimes use the NDX. So you want to respect it. You want to pay attention to it. We look at it a little bit, but ultimately, I think what controls the Nasdaq is the Q options position. And then the other thing to think about, which I've been trying to gauge for a while, and I think what I'll do is I'm going to add like a FANG gamma index, is that the biggest Q positions are also the biggest S&P positions, right? Apple, Tesla, those are tech stocks. Obviously, it's no secret there, but how does all that play in together, right? Because they're so linked, because the market cap of those five, top tech companies are so large in both indices that I think, there's kind of interesting dynamic there. So, anyways, I'm going to leave it at that. I thank everyone for showing up today. I hope this was helpful. I know I kind of rambled on about random topics, but I think people kind of like that. I hope you all will get a bunch of questions. Again, the note was a little bit delayed today. I apologize for that. We'll right back on track tomorrow. Fortunately, the models, I think, did us proud today. That 44.25 resistance held. So it was a little bit late, but hopefully got out in time for everyone to realize that 44.25 was the thing that was going to hold today. If you have any questions, put them in the comment section below. Send us an email. info@spotgamma.com is our support. We've been working hard with support. Julia, who's on our chat today, is usually the one helping to answer a lot of those questions. So always feel free to say hello to Julia. And we're at SpotGamma on Twitter as well. So thank everyone for your time, and good luck trading. See ya.